Brian, you heard Courtney's report just there and how there's quite a divergence of views among many analysts, where some believe that stores like Macy's will succeed. Some believe that that you should ditch that as an investment right now. Where do you stand specifically on Macy's before we talk retail more broadly?
Well, good morning. So, look, I don't cover Macy's, but what I will say is, as I've been doing this for some time now, I think developing an outlook for the next year is more difficult than I ever remember. Because look, there's a lot of variables out there. Obviously, the biggest one is COVID. So as I think about our playbook for 22, I think it's going to, once again, at least in the beginning, will be very much a year of ups and downs. But I think the way to play this is to look for those companies that have the ability to both benefit as the COVID crisis continues, but also benefit as the COVID crisis fades, as it will. So to follow on Courtney's comments, I very much like Nike and Lululemon. I think the athleisure space is positioned extraordinarily well here. But to add to a couple names to that list that weren't mentioned, like an AutoZone, the auto parts business is tracking as strong as I can ever remember it right now. And AutoZone is just an incredible operator. And then also a name I talk about a lot on this show is Lowe's. So Lowe's in the home improvement category benefited a lot through the pandemic. But I think that I call it a self-help story. New CEO driving even better results. As these pandemic headwinds, tailwinds, challenges fade, I think Lowe's will continue to perform very well. And I think the shares are attractive there.
But Brian, in this part of the year, we see this trend over and over again, pandemic or otherwise, where you see a buildup in retail over the last quarter of the year, but then there's almost a sell on the news when the companies start reporting earnings in January and February, and they talk about how promotional they had to be or how high return volume was. And I'm wondering if you anticipate a similar cycle coming up this year, if you think that this time is different.
Look, I know it's always dangerous to say this, but I think this time is different. We talk a lot about the supply chain issues and, the impact that's had on sales or in some cases expense infrastructures of these companies. But the silver lining of these supply chain issues is there's simply not that much product out there. So that really limits the threat of price promotions. And what's happening is these much better run companies like the Nikes, like the Lululemons, like some of the others that Courtney mentioned, they're in a strong position because they're not having to contend with potential price promotions at weaker operators just because the product isn't there. So I really do believe in that. On that front, it's going to be different this time.
And then in terms of gift cards, when consumers hear supply chain issues and possibly not getting your gifts by Christmas, one easy solution is just to get a gift card or an e-gift card. But of course, the retailers can't register that revenue right away. So when do you think some of that revenue volume will actually come into play for these companies?
Yeah, it's a great question. And typically that dynamic lends to sales, basically now and through February. I mean, interestingly enough, my wife gave me a gift card because she couldn't get the product she wanted me to get. So that's a tailwind for sales. I think that could be a stronger. That could be more at play this year, just given, like you said, the supply chain constraints and as people were thinking they couldn't get the product they actually wanted to buy.
Yeah. And Brian, finally, before we go, we've been talking throughout the morning about the news from Apple that it will be temporarily closing its New York locations, citing the rise in COVID cases there. I'm wondering whether you think other retailers will follow suit, especially in the Northeast, and what, if any, material impact that could have on the bottom line.
Yeah, so we're watching very closely. When this all began back in early 2020, Apple was one of the first to close the stores then. So, look, I very much think that given what we're seeing at Apple today, that others will close stores. I'm optimistic that the closures will be much more limited this time. But the key here is, again, one of the themes I keep talking about with our clients is the strong getting stronger. These companies, a lot of the names we mentioned here have very well built out online operations. So yes, it hurts when the stores close, but their businesses don't shut down. These consumers can continue to shop online. So to answer your question, I think we will see more store closures. I think they'll be limited, but for most companies, that's not a massive problem given their online operations.